Hi, this is Kurt Kringles, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The month of June was characterized by several investor sentiment swings in relation to the UK Brexit vote. After a soft start to the month, the fixed income market staged a surprisingly strong rally during the week heading into the UK Brexit vote. The fixed income markets had begun to sell off on the uncertainty related to the vote, but the last-minute rally pulled excess returns for the month into positive territory just prior to the vote. The unexpected vote results by the UK in favor of leaving the European Union led to a renewed risk-off response. Consequently, most of the fixed income sectors, except for the emerging markets, ended the month with negative excess returns, although the market tone swung back to positive during the final days of the month. Uncertainty regarding the outcome and implications of the UK's vote to leave the European Union led to negative excess returns for the corporate market, but the commodity-oriented industries showed surprising resilience, leading to positive excess returns for the month for those industries and continuing their recent string of outperformance. Performance across the rest of the corporate market was influenced by an array of factors. The sharp rally in Treasury yields left industries with more exposure to long-duration securities, such as utilities and communications, at a performance disadvantage, as corporate yields did not fully follow Treasury yields lower. The financial industry suffered from business exposure to Europe and the UK and from concerns about the longer-term fundamental impact of lower interest rates and a flatter yield curve. Some of the industrial industries also suffered from business exposure to Europe and from near-term growth uncertainties. The year-to-date corporate market relative industry excess return positioning remained virtually unchanged during the month. A meaningful retracement in commodity prices will likely be needed to dislodge the energy and basic industries from their leading positions. The persistently lagging position of the financial industry is important given the 30% weight of the industry within the corporate market. If the significant drop in Treasury yields after the Brexit vote is sustained and concerns about the health of the European banking system linger, it could pose an ongoing performance challenge for this key industry. Aside from the commodity-oriented industries, little performance differentiation exists across the rest of the industrial universe, leaving open the possibility of some shuffling of relative excess return positioning as the year progresses. The evolution of Brexit-related concerns and the second quarter earnings season will likely set the near-term tone for the corporate market. A solid earnings season should be supportive of modestly positive excess returns if Brexit concerns do not overshadow the results. In recent years, the corporate market has generally delivered its best performances during the earnings release periods, as positive earnings surprises tend to outweigh other macro concerns. Heading into June, the fading of post-Brexit fears has been rapid and seems poised to support returns. Looking further out, we could see a stable U.S. dollar, range-bound oil prices, and improved economic growth momentum contributing to positive excess returns during the second half of the year. However, low interest rates could be a performance hindrance for the sizable financial industry, and risks related to Europe and China still remain and could resurface in investors' minds. Consequently, our medium-term outlook calls for largely range-bound spreads and modest excess returns with periods of volatility leading to tactical positioning opportunities.